Hello everyone, it's Davide here and welcome back to Learning Finance. Now, today's video is quite special because finally the channel has reached 10,000 subscribers, so I have to thank you very much about that. I am very grateful and I appreciate your support. You are awesome, every single one of you. Thank you very much again. So in order to celebrate these 10,000 subscribers and in order to thank you for it, I'm gonna do a video that I have been requested very much about it down in the comments. So things like, can you share the template? Can you show me how to do a valuation, discounted cash flow valuation? So in today's video, I'm gonna show you how to do it, step by step for beginners. Basically, everyone can do it for the discounted free cash flow method valuation. And I'm gonna also share a free template down below in the description. You can download it. It's from Google Drive, so you can download it and then do whatever you want with it, try and play with it. As always, the only thing I ask you is please an early like. It's very important. I want to grow this number even more, so thank you very much. Early like, I appreciate, and subscribe to the channel so you don't miss any new updates. Let's begin. Now, when you download the link from Google Drive, this is what you are gonna see, okay? This is the page. Here I put the formula so you can actually have a better understanding on what's going on here. I'm not gonna go through all of that, otherwise it is too boring. And here it is, guys. So we are gonna go through all of this and I'm gonna explain you what it means, how to do it. Now, an important thing, I wrote it down here so you can remember. You have to write only in these green cells, okay? These green cells over there. Whenever you see this, you can actually write in there. If you write in other cells, there are written codes. So obviously, if you just write it and change it, then the template, it doesn't work anymore, okay? So just pay attention to that and then you can go and type whatever you want. So in today's video, I'm just gonna do a pure example, okay? Random example. We are gonna take Apple stock just to show you how it works so you can replicate it with other companies. One thing to remember before we start is that not all the companies are valued in the same way, okay? So you cannot use this to value all the type of companies in all the sectors, okay? Like for example, if you want to value financials, you don't value financials with a discounted free cash flow. Or if you want to value very small companies, unprofitable companies, like strong growth companies which are not profitable yet, this is not the method, the exact method, okay? So here you need a little bit more of a mature company, a little bit more of profitability, okay? So you need profitability in order to do this. And another important thing is that the company can pay dividends, okay? So this is fine. However, the payout ratio doesn't have to be too high, okay? Otherwise, this method, it is not the most appropriate, okay? So anyway, for all the other companies, you can do it, and I'm gonna show you how. So first of all, we have said Apple stock, okay? So what we do, we go over there and we type Morningstar. Here it is, morningstar.com. And here you have, now this is a very interesting website. It is free to use. Obviously there is also the premium version, but for what we need, it is free. You go on the search bar, select Apple, here it is. Select the stock. Here we have quote. You have a lot of data that you need. You go on key ratios, full key ratios data. And then this is the page that you're gonna see, okay? Here we have, you have like revenue from 10 years, margins, a lot of interesting stuff. Payout ratio, you see it is not too high, it is not above 60, 70, so we can use this method. EBITDA margin, this is something very interesting. And then you click financials, you go to cash flow, and then you go down, and here is what you need. Now, first of all, there are many different ways to calculate free cash flows. The most important ways are two ways: free cash flows to the firm and free cash flow to equity. Now, I assume that a lot of you don't have a financial background, okay? Maybe you have different backgrounds, you are a doctor, you are whatever you are, it is perfectly fine. I'm gonna show you the easy method, okay? Because if you want to calculate a pure discounted cash flow with the free cash flow to the firm, and then also the WACC, which is the weighted average cost of capital, it is becoming pretty tricky, okay? Because they teach you these things at university, or if you do a financial courses. However, it takes time, okay? It takes time. There is a lot of assumptions that you need to do, and it is easier to go wrong, okay? Now, this method, it is pretty simple. Everyone can do it, actually. You don't need to do too much stuff. You just need the right data to put in. And the end result, it is pretty similar. Obviously, the other one, it is more precise. It is the one used by analysts, investment bankers, and stuff. But with this one, you have a pretty good idea, okay, on the fair price of a stock. So let's start with this. For the free cash flow to equity, the easiest way to do it is this one, basically. You take the operating cash flow and you deduct capital expenditures, okay? Now, the right way to do it, you should also net borrowing. However, it is not easy, especially going on, to predict net borrowings, okay? So to understand how much debt will the firm need in the 2, 3, 5, 6 years, okay, going on. So this is probably the easiest way to do it, and you don't do just mistakes because of debt, okay? Just take into account capital expenditures and deduct it from the operating cash flows. So here is what you need, basically. In Morningstars, you already find the data that you need. However, if you don't find the free cash flows directly, in this template, basically you just put operating cash flows, which you can find them also on Yahoo Finance, for example, and the CapEx, and then it will calculate automatically the free cash flows to equity, okay? So let's start by copying and paste operating cash flows and capex. The ticker symbol, we have said it is Apple. So here it is, so you understand what you're doing. So here you have pasted operating cash flows, and here you have pasted capital expenditures. Now remember to put those things in negative, because then the model is gonna sum those things. So by putting the negative, which is a cost, the result will be the correct one. Then what we need, it is revenues. Now here I put the previous 5 years, should be enough to give you an idea. What you do, you go to Morningstars, once again, income statement, revenues, and then here you have them, okay? Just copy and paste them. Here it is. And then net income, same stuff. Here you have the net income, and then you copy and paste it. So what do you have now? As you have seen, I've just put the data on the green cells, okay? Remember that. What you have is automatically calculate the free cash flows to equity historical one, okay? When you see yellow, it is historical data. Then it also calculates for you the net income margins, and it does an average of those, the free cash flows divided by net income margins, and it does an average for you, and then the revenue growth, which is from 17 to 2020, and it does an average for you. We have the historical data, we have the averages, which we need. So now we skip to the forecast part, okay? Now, when you see blue, it is estimates. As you can see, I just put until 2028, okay? Now, the first two are in green. Why is that? Because for just the next couple of years, I like to start and take a look to analysts' expectations, okay? So, because there are a lot of analysts following companies, they listen earning calls, they do all this kind of stuff, they do questions to the management, and then because of that, they give you a guideline on the revenues. Okay, so my starting point is always the analyst's average expectations, okay, for the next couple of years. Then if I like them, I just copy and paste them. Otherwise, if I want to be more conservative, I just put a little bit less or a little bit more if I think it's gonna be better. Easiest way, you go on Yahoo Finance, search for analysis, and then here is what you're gonna have. We go down until here, revenue estimates. You have the low, the high, and the average. So I take the average, 2021, 2022, copy and paste. Once you have the first 2 years of analysts' expectations, then you have the growth rates. Okay, so you have, I put from 2023 to 2025, and then the second step 25-28, and then you put the growth rates. Okay, so just for example, let's start with I don't know, Apple 12, and then we put 10 or 9. Let's put 9 here. It is just a random example, okay, just to show you how it works. And as you can see, here it automatically calculates the revenues for you, okay? Starting from 2023, it's gonna go at 12% until here, and then a 9% until here. And this is what you are gonna get. You see, the green one are those two lines. The first one is the net margins. We have calculated, if you remember, the average of them in the previous 5 years, which is 21.37. What you can do, you can actually directly copy and paste this average and then assume it's gonna be equal in the future, or you can actually change it manually for every single year that you want. Okay, so the easiest thing, you just take the average and then you go there. Remember, when you copy a formula, you have to do right click and then paste special, and then you go there and you do value and number formatting. Okay, otherwise you make a mess. And if you want to just use 21.37 for all of them, you take the cell, drag them until here, and here you have, okay, you see that automatically you have also the net incomes. If you want to change them, let's say, I don't know, you want to try different things and you say, you know what, margins are gonna be 25% in 2023, you just change them, and then as you can see, you can do basically whatever you want here, okay, just put the number you want and the system is gonna automatically recalculate the things for you. However, to just show you the same stuff, I'm gonna do the 21.37, which is the average. Exactly the same stuff for the free cash flow divided by net income ratio. Okay, so here we have the average 112.32. I just copy and paste this one. Remember, right click, paste special, value number formatting, and then you just drag it down, boom, and you have the free cash flows to equity calculated for you with these growth rates. Okay, now if we change the growth rates, as you can see, everything changes. Okay, the green one here remains the same because it's the one that you have to put. This is the normal case scenario. Let's assume a 13 and a 10. Okay, just random. What you want to do, you copy all this line directly as it is, and then you go there in 2021, right click, paste special, value and number formatting. Okay, important, boom. The terminal value, as you can see, it is not green because it's gonna automatically calculate it for you according to the requirements, okay? Because you have the perpetual growth, which usually I put 2.8, especially in the US, which is the growth rate of the economy of the US on average. After 2028, if you put that, you assume that Apple is going to continue to grow at a 2.8% forever, okay? So this is the idea, because we cannot predict exactly how much is going to continue to grow. 10, 15, 20 years ahead, okay? After a while, you just put a terminal value and then that's it. Now be careful, if you put this one too high, then you're gonna have a huge valuation, okay? It doesn't make sense, so be very careful with it. Usually take it around 3%. And then the rate of return, I just put 8.5, usually for US stocks, big stocks, I just put between 8 and 9. For Chinese companies, which are a little bit more risky due to the environment, I just put 12% usually, okay? So what you need to do now, because as you can see, the model has already calculated for you the today's company fair market cap, okay? 1 trillion.87. Now you need the total amount of shares outstanding, which once again, you go on Yahoo Finance, select statistics, go down, and here you have, okay, shares outstanding 16.82 billion. So what you want to do, you go over there in the green cell and you select 16.82, and that's it, okay? That's the fair price according to this scenario with this growth rate. We do the same stuff. This time it is a bull case, okay? So for a bull case, I don't know, whatever you have in mind, that's just a random example of 15% instead of 13, and here let's put 11. Once you change it, if you want to change net margins, the free cash flow divided by net income, just do whatever you want. In this case, I keep them the same. I just copied them, so the free cash flows, and as always, as before, right-click, paste special value number formatting, boom, and you have it. Fair price, $2 trillion. Once again, you just put the same shares, and then you have the fair price today, okay? Around 120, 119.28. Now remember that all the numbers here are considered in billions, okay? So it is 1 billion, okay? That's why 16.82, it means 16 billion, 0.8 shares outstanding, okay, as well. All these numbers are in billions, okay? So if you need to put million, for example, let's say 900 million, you just put 0.9, okay? And that's it. Perfect. Now the bear case. Let's say things are getting ugly and Apple doesn't go as much as we think. So let's say we put just 10% until 2025 and then we go down to 7. You see, the system calculates for you the new cash flows. So you just copy them, go there, right click, paste special, value number formatting, boom. Once again, you put the shares 16.82 and that will be the fair price of Apple, okay? The requirements, if you want, you can change them. However, usually I just keep them equal for the different scenarios, okay? So once we have that, here we calculate the average fair price, okay? Now, usually if you have seen my videos, I do 3 to 5 different scenarios and then I calculate the average fair price. How do I calculate it? I'm gonna show you. First of all, you see the green, so the only place where you need to put something are the probability cells. Normal scenario, here you have the fair price. Bull, that's it. Bear, that's it. Now you want to put probabilities. You just select normal one, simple as that, 0.5, the other two, let's say at 0.25. Okay, now the result here has to be equal to 1, okay? This is very important. This just calculates it for you. You see, if you go wrong, let's say here you put 0.6 and then it says it's 1.1, it doesn't work like that. Then you can change them however you want. For example, here you just put 0.6 and then you go on the bull case and say, you know what, this is not likely, then you put 0.15, okay? And it is equal to 1. What this thing does, it calculates you the average fair price, okay? The final, according to the fair prices you have found in your scenarios and the probability you put in those scenarios. See that if I put 0.5 and here I put 0.25, the price actually changes. So here is basically the template. I hope that you're gonna find it useful. It is pretty easy to use once you understand what you need. If you don't understand it, firstly, just watch the video another time. Otherwise, leave me a comment down below with your question. What you need to remember, just write in the green formulas and that the numbers are in billions, okay? So if you need to write millions, you just put 0 comma, depending on what type of Excel do you have, and then you put, for example, 900, 0.9, okay, millions, and that's it. So according to Warren Buffett itself, the only way that actually makes sense to value a stock is to discount the future cash that the company is able to give you, okay, in the future. So here you have the template, discounted cash flow. I hope you find this video interesting, guys. Leave me a like and thank you once again for the 10,000 subscribers. Leave me a comment down below, subscribe to the channel, and as always, guys, have a wonderful day.